All right, cool. Well, I'm real excited. Today we have back with us the St. Louis real estate ninja. His name's Ben Dao, local realtor here, and he's been investing in properties for how long is it?
14 years
Four,
here, at least.
14 years? Awesome. So we're real excited to have you back, talk about real estate investing with you and learn more about you and the process and all that.
Great. I'm happy to be here and I'm looking forward to giving value to the audience. A lot of my clientele is investors
Hmm.
and they ask me how to get started, what's the first process? And I always tell them first, let's get pre-approved with Brian.
Yeah.
Let's see if you can actually qualify first before we look at properties and make offers.
Hmm.
So in this podcast, I kind of want to just kind of break it down to the basics so we can save time and educate people.
Yeah, that'd be great.
A lot of times I send them to you to get pre-approved. What are the first steps that you look for or ask them as far as like the application?
Yes, first, I really like a relationship built. So we like to learn a little bit about them and what their goals are, long term and short, with rental properties and kind of their experience already. But then really it's looking at their financials. So one of the things we suggest is, especially moving forward, is to make sure you keep really good records. Keep your taxes, your W-2s if you're employed, whatever. Keep good records of your income and all that good stuff. We're going to qualify you based on all that, right? So we're going to get a loan application taken, pull their credit, get their income nailed down. If you're a business owner, sometimes that can take just a little bit longer because it's not
Yeah.
just a simple, hey, I make 500,000 or whatever the number is, and that's what we can use to qualify. There's a calculation that we have to go by, and it's qualifying income. And depending on how creative your accountant is, I guess, or how
Hmm.
your accountant looks on your tax returns, where what boxes are filled out for the income, that drives your qualifying income. So we're looking at it's really a three-legged or four-legged stool. We're looking at your debt to income.
How
We're
much
looking
debt you have compared to your income?
exactly right. We're looking at can you repay the loan? So your income in general. We're looking at your credit and credit history and the property, right?
Right.
And
The value of
the
the
value of the
property.
property, yep, the
Okay.
appraised value. So that's really the four legs of it.
Okay. Okay. Some people don't like to have their credit pulled all the time when they're shopping different lenders.
Mhm.
Can they send you a credit report that they already pulled, let's say, but within 3 months?
It's a good question. We get asked that a lot. The answer is no. But we can do a soft pull.
Okay.
And a soft pull, it pulls in all the same information as a hard pull, but it just doesn't hit your credit. Once we go under contract on something, we do have to switch that to a hard pull, but we can certainly start out with a soft.
Okay.
Yep.
And I've studied credit for a little while, and you do a hard pull here and there. It's no big deal. But if you start
Hmm.
doing 10 in 1 month, then it can kind of hurt with a
Hmm.
lot of hard inquiries. What's the rule of thumb now as far as how many pulls in a certain amount of time to not, you know?
I'd have don't quote me. I think it's around three in a month,
Okay.
if especially for the mortgage side. Mortgage pulls are looked at a little bit differently. You are buying it in general. You're buying an appreciating asset, right?
Right.
So it's not like you're taking on consumer debt like credit cards, cars, stuff like that. So it's looked at differently.
Mhm.
But I think around three in a month is probably all right. I can get back to you on a more finite number on that for you, but
Okay.
that's not going to hurt your credit having three. Yeah.
Okay. So how long does that process usually take? Standard, is it a couple days, a couple weeks?
It's a good question. If it's relatively simple on the income side and everything else, I can get someone pre-qualified or pre-approved in the same day. So it's quick. If there's things that we have to dig into further, if they're a business owner and we have to get tax returns, and depending on how their business is filed, if it's a Schedule C, which is on their personal returns, or if it's they file separate returns for their business,
Hmm.
we might have to get personal returns, business returns, K-1s, W-2s. So it
Oh
all
yeah.
depends on how it is, and then we have to dig into it.
Oh yeah. It gets complicated then.
Yeah.
Um,
So it could take a day, it could take a week.
But from my understanding, the main documents that you need, W-2, tax return, bank statements.
Mhm.
Are there any other things that people should be prepared for when
Right. So you said W-2s, paycheck stubs, bank statements, your ID. If you own a house and you're buying rental properties, we need the mortgage statement
statements?
on each one of the properties that you already own. If you escrow taxes and insurance, we don't need your taxes and insurance as well. It's going to show on that mortgage statement. But that's usually the bulk of it.
Okay.
Sometimes we need a little more, but that's the bulk of what's needed.
And the standard um, loan for a rental property, is that a conventional loan in FHA or DSCR? What do you usually see?
Yeah, so we've found that through looking at the numbers, in most cases, once you really dive into it, a conventional loan is going to be your best loan when you're acquiring rental properties. And it's just because they typically are less expensive. The rates are going to be better. So it's a better product in most cases. It's not always the case. Sometimes it does vary from that, but usually up for the first 10 properties, as long as they can afford it,
Mm,
conventional is going to be the best route. Now, if you're house hacking and living in one of the units, if you're buying multifamilies, you can utilize a conventional loan and put down as little as 5%. You can also utilize an FHA loan if you're going to live in one of the units and put down as little as 3.5%, which is great to do. So if you want to, in the next 10 years, acquire 5 properties and do it slowly over time, you could buy the first one as a FHA mortgage with 3.5% down, live in it for a couple of years, and rent out your other 3 units. Then buy another 4-family unit with a conventional loan with as little as 5% down, live in it for a couple of years, and so on. Rinse and
so,
repeat.
FHA, what is that? Is that the first-time home buyer?
That's a good question. It's not, it's a, most, it gets positioned with first time home buyers more often, but it's not actually a first time home buyer program.
Gotcha.
It stands for the Federal Housing Administration, but it's just more forgiving, if you will. So you can put down a little less money in some circumstances. The debt to income can be a little bit higher. They're more forgiving when your credit score is lower with the interest rate. So it's a more forgiving loan product.
Mhm. But do you need to have private mortgage insurance because it's only 3% down?
You do. Yeah, you do. And to get that private mortgage insurance off, you would eventually have to refinance it into a conventional loan.
Okay. So
Yeah.
even if you paid off some principal and got under 20% or 80%,
Hmm.
you can't exclude the private mortgage insurance?
Yeah. In most cases, you have to refinance into a conventional loan. Yep. A conventional, it falls off automatically. But yeah.
Okay. Okay. And with FHA, can you only have one of those mortgages?
Yeah, there are some caveats on how you can get a different one, but it's not going to be in the rental arena. It's going to be, if you live in an FHA house, loan with a house with an FHA loan on it right now,
Hmm.
if you're moving more than 100 miles away because of work and all that, you can get a second FHA loan at the same time. But typically it has to be but it has to be your primary residence. Or if you have a house and you have a growing family, there's certain stipulations around that where you need a bigger house. You can utilize another FHA loan.
Okay.
But typically, rule of thumb is one FHA loan.
Okay. Gotcha. Gotcha. And what are the requirements to actually get approved? I want to talk about minimum
Hmm.
credit score, down payment, reserves, just so people can kind of firsthand know if they can actually qualify.
Right. So typically, you're going to want to see a 640 credit score or better. On DSCR loans, a lot of times they want it to be 660 or better. There are certain investors that'll go lower than that, but usually 640 or better for investment properties. And then higher is going to be better for you. But um, reserves, it just depends. If you're buying your first investment property, we don't need as much in reserve. Sometimes we only need 2 months.
2 months of mortgage payment.
Yep.
Okay.
You have a PITI, which so principal, interest, taxes, and insurance. Yep.
Okay. So if that payment was, let's just say, $2,000 a month,
Hmm.
then you would like to see $4,000 of
Yep.
reserves.
Hmm.
Okay, that's not bad. I thought it was more like 6 months or.
Sometimes it is 6 months. It just depends on the scenario. And then a lot of times when we run findings, it's going to tell us, hey, you need X amount of reserves in the bank. But rule of thumb, if once you have multiple properties, you're going to want to have 2 to 6 months in reserves.
Per property.
Yeah.
Yeah.
Yeah. And then different investors have different requirements on that.
Okay.
So, yeah.
But
And then,
conventional loans are usually, is it still 20%, 25%
so
most
one,
likely?
yeah, so that's a good question. So if you're buying a single family unit, you can do as low as 15%.
Oh, is that new? Because I remember,
Uh,
with the financial crisis, it kind of went up. When did they lower that?
It's been around for a little while now,
Okay.
but the problem is I don't know, this is kind of going a little into the weeds, but there's loan level pricing adjustments that Fannie and Freddie put in place on pricing.
Hmm.
So if you don't, and they're doing it because traditionally Fannie and Freddie, around 7% of their book loans they backed were investment properties or second homes or vacation homes.
Hmm.
Now it's, don't quote me on this, but last time I read it, it was around 11 to 12%, which their concern is There's not as many houses out there for people to buy primary residences,
Okay.
or it's getting more expensive or harder to get into. So they're making the barrier to entry a little bit higher. So if you don't put 20 or 25% down, you're getting dinged pretty hard on
Interest rate.
pricing. Yep. Interest rate. So typically your best bet is to put 25% down and you get the best terms.
Okay.
So sorry, it's a long-winded answer to that, but you can put as little as 15% down.
Okay.
And then once you get two families or more, like 2 to 4 family, 25%.
Okay. Gotcha. Can you talk to me about debt to income ratio and are like the minimum requirements and kind of break it down for everybody?
Yeah, debt to income is simply it's just how much money's coming in each month versus how much debt you're paying on, right? So
Oh,
if
so
you're
like if you have credit card or student loan
yeah,
payments, you want to be a certain percentage of your take home income or
it,
gross income?
gross income is what we go by.
Okay.
So when you're thinking about that for yourself, we do go off gross income. So if your debt to income on that rental property we're buying is 49%, that's on your gross. So you got to keep that in. You got to look at your budget and see, are you still going to be in good shape if you're doing that, right?
Right.
But it's, so if you're making 10,000 a month and your total debt load, including the new house you're buying and your house and whatever else, is 4,200, your debt to income is 42%,
Percent. Okay.
which you're in line, which is great.
So do you want to be 50% or less or
45% or less, but we can go up to 49.99% or less, depending on the scenario.
okay, so that's good for people to know just to make sure they either clear some of that
Right.
or either make more or show more income or somehow so they can get qualified.
Exactly right. And with that, oh, I had somewhere to go with that. I totally lost it. Okay, we'll come back to it.
Okay.
Yeah.
What
Oh,
about
that's what I get. I'm sorry. I got it.
go
So
for it?
debt to income, we count things like credit cards, student loans. Even if your student loan shows zero payment due on your credit report, we have to factor in a payment
Oh
as
yeah.
if there was one.
Oh yeah.
And depending on the loan product, it's either 0.5% or 1% of the balance. Even if you don't have a payment showing, we still have to do that.
Yeah, because student loans, a lot of people are in forbearance,
Right.
deferment.
Exactly. So we know the payment's going to be there eventually.
Oh yeah.
So we got to show something. Um, so student loans, credit cards, car payments, house payments, we don't count things like cell phone bills, utilities, stuff like that.
Because
But
those can stop
yep,
easier than an obligation like a student loan car,
right.
student loan or a car payment.
Exactly right. Yep.
Okay. Okay. What about the income for the investment property? So as investors, our goal is to at least cover the mortgage
Right.
with rental properties. So do you guys factor like this house is 200,000, it can rent for 2,000? That's income. Does that count?
On the house you're buying, it is not considered income, but we can use it to offset the mortgage payment. So if you're buying a house and your rent coming in, again, it depends on the loan product and all that too, and companies, but if you're buying a house and your rental income is going to be 2,000 on it,
Hmm.
and that's what it rents for, and you have a lease, they have a 12-month lease on it and everything, but your mortgage payment is 1,600, we can't use that extra 400 for income. We can only offset
The
the mortgage payment.
so you can show it break even.
Essentially, pretty close. We'd still have to hit them with like $1 or so, but yeah.
Okay, but you need that lease in place first because usually houses are vacant,
hmm
and then yeah, then you know move in somebody afterwards. So or can you go by a previous lease or how does that work?
Current lease or by the rental income that's shown for that area. So
Right.
the appraiser's going to go out. They're going to appraise the property,
Okay.
and they're also going to do like look at the rents in the area and
Hmm.
see what they are.
Hmm.
And as long as it's within range of where it needs to be, we can either offset or hit them or we can utilize up to 75% of that.
Okay. And what are some challenges, for borrowers or investors or common mistakes people do like buy a car before they do it or
Yeah,
change jobs, are there any things that people should, watch out for before getting
yeah.
qualified?
So some big no-nos: don't change your job. It's not always a deal breaker if you let us know in advance that this is happening and it's a similar job. So, like if you go from a W-2 salary job to a new W-2 salary job and we can get all the correct documentation, we're fine.
Okay.
Switching to hourly, that can be a deal breaker. But typically, we don't change jobs. We'd rather not. Don't take on any new debt. Don't buy a new truck. I did have a client, it's
Hmm.
been a number of years back, that purchased a truck within a week of closing. And we already had the conversation of don't open up any new debt. Don't buy a car. Don't do anything. Don't even like you can furniture shop. Like window shopping used to be a
Yes.
thing where you could go shop and not buy something.
Yeah.
You can window shop, but they bought a truck and they didn't qualify. They couldn't buy the house anymore.
Yeah. Just wait a few weeks until after
Right.
you close, right?
Had they waited like 6 days, they would have been able to close and buy a new truck.
Yeah.
So yeah, so I'd say that make sure you're keeping again your finances in good. Keep paying everything on time. Um, keep good records because sometimes we do have to dig further into things. It's kind of like construction sometimes on the income side of it. If we get all your docs, it's kind of like opening up on a wall. Like let's say you're getting a plumbing redone in your kitchen. They open up the wall. They see there's issues with the electric as well, or whatever else. It could, sometimes we have to ask for more stuff then.
Yeah.
We don't
Yeah.
want to. We don't want to do more work than you guys, just like you guys don't want to, but we have to make sure the income's solid. So
Okay.
keep good records.
Speaking of verifying income, there used to be like non-stated income and those type of things. Are there any products out there now with less documentation?
Yeah, so there's like bank statement loans, and we're looking at basically money flowing in and out.
Oh,
There's
really? Okay.
and then there's you have to get 12 to 24 months depending on the program.
Oh,
There's also DSCR, which yeah, let me read it off. It sounds better when I read off the definition. Essentially, you're buying a mortgage that's not predicated on your income. We're looking at your credit score and then the projected rents for that mortgage. Can the rent can the rent on that property cover the mortgage that you're taking out? So if they go out, they appraise a property and your credits, let's say your credit's 700 or better, you're putting 20 to 25% down. They go out, they appraise the property and it's worth what it needs to be. They also do look at the rents
hmm,
and your mortgage is whatever, 1800 bucks. And as long as the rent rolls cover that, you're getting 1800 bucks projected or better, then that's a 1-to-1 ratio for DSCR, you're good.
okay. As long as it can cover the mortgage, then you can qualify.
Yep.
Um,
We do have some that will go lower than that, but there's other caveats that come into play if it does. So like we can go 0.8 to 1. So like if it's the mortgage is 1,000 and the expected rents are going to be like 800 to 900, we can still do it. The terms are going to change though,
yeah,
because there's a higher risk for the investor, right?
yeah, because they have to come out of pocket a little bit. So then, when you say risk, does that mean the interest rate goes up or more
Yeah,
points, or
probably
what
it's
is it?
going to be, yeah, interest rate's probably going to be a little bit higher.
Hmm.
The costs are going to be a little bit higher because of it and all that.
Okay,
Yep.
so it's all about buying right
Right.
and yeah, the 1% rule and
Hmm.
whatever.
And some of that, it's still not, sometimes it's still good. You can still move forward and it be a good property to buy. And that's where they need to lean on you more and say, hey, Ben, what can I do to get the rents up for this property? And if there's certain things they can do to do that, it still might make sense to move forward.
So we were talking about conventional loans, and most of the time that you start off, on your first couple of properties, what happens when you get to multiple properties, 5? And I know things change after 10 because you can't have a certain amount. Can you go into what investors usually do at that point?
Yeah. So a lot of it depends on their cash flow and other things like that. But you can only have 10 mortgage properties with Fannie Mae and Freddie Mac at one time.
And that's conventional.
Conventional.
Okay.
So once you have those 10, then we need to look at other options like bank statement loans or DSCR loans, which are the debt servicing loans, debt servicing ratio. Um, those are other options that we'd for sure look at. But as long as they have less than 10, though, again, if we can do it go that route, it makes the terms are going to be better on conventional
Okay.
usually. Um, There was something else I wanted to add to that. Oh, so like let's say you buy a property this year and we buy it in October. It's January, or let's say it's It's April of next year. Sometimes you're not always reporting that new property you just bought on your taxes because you haven't owned it long enough,
Hmm.
right? So if it's not reported on your taxes, we can offset that with your 12-month lease.
Okay, so
We
that's a
take
document as income.
we take that into account when we're calculating your income based off that property. Once that property is on your taxes supersede your rent. So let's say you're on your taxes, you write that property off to where it's only making $100 a month for you. Even if your lease, you're clearing after you pay your mortgage payment $500, so it would be 6,000. You're clearing on that property as income. We can't use that. We don't look at it. We have to look at your taxes. So once your rental properties are reflected on your tax return, that supersedes your leases.
Okay, yeah,
As
yeah.
far as
There's some
qualifying,
lag time there. Yeah.
yeah, as far as qualifying income.
Okay. Another question I had for you is, let's say a property is already stabilized, which means it's rented and managed,
Hmm.
and it's turnkey.
Hmm.
Does that matter at all as far as financing, getting loans, rather than just a vacant house?
Typically not. No, I mean we can use the projected rents or the lease. Um, in most cases in our industry, it's we go by worst case scenario.
Yeah,
So,
yeah, have to.
um, but yeah, I mean, typically that's not going to make as big of a difference for us on our side of it.
Cool, cool.
Yeah.
And one final thought here is a lot of investors, what they like to do is they buy properties with hard money,
Hmm.
so they can get the deal, cash offers, and then they fix it up and then they refinance it. What are some advantages and disadvantages of that on the on the lending side?
Hmm. Um, well, hard hard money. That word kind of puts it. It's hard. It's cost more, right?
Yeah.
It's going to cost more typically than a DSCR loan. It's going to cost more than a conventional loan, but it can be a great tool to get into some properties. And we find a lot of investors like that product, especially starting out, because they can either a flip some properties and start get some cash out of it, um, or use that for long term holds until they build up cash otherwise. But we like to work with the people who do that, and we like to talk with them before they start that process with a hard money lender, because what we do is we get them pre approved for the takeout loan,
Up front
right?
before they buy.
Right. We want to make sure we can approve them to take them out of that hard money loan as fast as possible. So if we get them fully pre-approved and then they go into the hard money loan, once they're within 30 days out of being fully finished,
Hmm,
or when they're in a spot when we can get that appraisal ordered, we've already got them pre-approved. We can order the appraisal. So within a week of them being completed on the property, we can be closing out the new loan for them. And in some cases, that can save them another month or two in hard money costs, right? Which could be a ton of money saved.
that's cool. Yeah, being prepared and
Right.
just planning that before,
Hmm.
because most people are just trying to get that deal closed, get that rehab, and then they kind of think about
Right.
refinancing out.
But
What's the penalty though, as far as how much higher is a refi than just getting the conventional upfront traditionally?
a refinance, I mean, it could be a half point to a point difference in rate. Usually not a point difference, around a half a point, give or take, a refinance versus a purchase. But if they're doing hard money, your rate typically what we're seeing people around here at least seems like 12%, give or take, is a rate you'd expect to see.
Hmm.
Depending on the loan amount and the hard money lender and all that, they might want 3 points up front.
Yeah, yeah.
That seems to be what we're seeing a lot of.
So it's short term. It's short term, but it gets deals done faster.
Yeah,
But once you refi, then it's stabilized and,
right.
and everything.
Because they're not looking as much stuff as we are when they're doing it. It's their, so the risk curve's a little higher for them, right?
Hmm.
Because their qualifications aren't quite the same as what we're doing.
Hmm.
But I think it can be a really good tool to get in. But yeah, the faster you can get in and out of a hard money loan, the better. Speed is your friend.
Yes, yes, yes.
Speed is your friend. Yep.
Um, you work with a lot of investors too, a lot of my clients as well. Have you seen anything as far as like changes in the market or in investors' mindset during this market time? Well, real quick, it's just like the market has slowed a little bit, so it's
Hmm.
more of a buyer's market now.
Yeah.
So more deals. more available inventory.
Mhm.
So I was just wondering if you saw anything on your end.
Yeah, I feel we're still seeing a lot of activity on the investment side. I feel like the investors that got into it a little while back that are more savvy, they're not as afraid to pull the trigger on buying investment properties in the last 3 years because they know that you purchase the property when you find the right property, right? Even if the interest rates are higher, as long as you can cover your cost, maybe a little bit more, you're not always gonna get you're not always gonna get a banger right now and make a bunch of money monthly on the properties. You can, but I think they know that they can refinance down the road.
Yeah,
And
I like that because you never know where rates are going to go, but most people think they are going to go down,
right.
and it's always better to have the property now than in 5 years.
Mhm.
So you can probably lower your payment once
Right.
the right time.
It's gonna be yeah, exactly right. To get into the property is gonna be a lot cheaper now than 5 years from now.
Yeah.
So I think a lot of people are still buying rental properties, but you're right. We are seeing properties sit a little bit longer now.
Hmm.
Um, we're seeing we still see depending on the house. I mean, if it's a crackerjack house and it's rent's great,
Yeah,
it's in a great area.
ready to
A lot of
go.
times we're seeing multiple offers, but we're not always. We're seeing more houses sit, so we're seeing houses come in and people getting seller credits. Not a ton, but we're starting to see it more. And on like an investment property, you can get up to 2% from the seller towards closing costs and prepaids.
For conventional.
Yep.
Yeah.
That's the max.
So
Yep.
2% seller credit possibility for a
Hmm.
conventional loan.
Yep. Yeah. But I think, um, I don't know if that's exactly answering the question, but we are seeing more opportunities for investors because there are more properties coming online. Um, and it's a good time to buy. A lot of people ask, is it a good time to buy or should I wait?
Yeah.
I think the right time to buy is when you find the right property.
Yeah. Yeah.
Again, if the rates, we can't control the rates, but they're going to come down. They have to come down eventually. It's cyclical. We've been through this cycle, what, 6 times in
Hmm.
the last since the 1940s or 50s?
Okay. Yeah. Yeah. So take it from Brian, that there's still opportunities out there. It's actually more opportunities right now than a couple of years ago.
Mhm. Yeah, I would
So
agree.
anyways, that's all I got for now.
But I mean, what are you seeing on your side as far as like rents and properties that people are acquiring? How's it? Because one to one.
Yeah, yeah. I do see that there's more inventory, but
Mhm.
rents are still pretty steady.
Mhm.
They haven't skyrocketed like a couple years ago, but the numbers are still there. I'm a big 1% rule guy, so that's what I strive for. And now with more inventory out there, you can find better deals. If you are good at improving the properties,
Yeah.
I like doing the whole 5 to 10 grand rehab instead of a major rehab. So yeah, with the right opportunities, I think there's more out there. But St. Louis, there's whenever there are good deals, they go fast as well. So it's a balance where there are out there, but you have to be fast still and
Right.
take a look.
So I
But
did want to touch on that with you. It seems we are one of the markets. St. Louis, I feel like Memphis, Pittsburgh, but St. Louis is a big market right now that a lot of people are buying rental properties in as opposed to others. Can you touch on that? On why?
yeah, yeah, I've been getting a lot of calls from out of state investors as well, just looking to park their money. Um, St. Louis has always been a steady rental property market. I've been buying here for 14 years.
Mhm.
So just with the affordability and being able to buy a 100 to $200,000 home
Mhm.
with the rates at with the rents. Also Section 8 has been really good for me as far as increases in rent. Um, no late payments, with
Right.
Section 8. So you just got to deal with different tenant base and neighborhoods. But overall, it's one of the best markets in America, I think, for cash flow, and I've been saying that for a long time.
I agree. I think we're sheltered from the big highs and lows that the East and West Coast are seeing, and it's been that seems like it's always been that way. Not to
Yeah,
say we don't have some dips and all that, but
yeah,
we're definitely sheltered. I think it's a very if you're looking at this compared to others, very safe market to invest in and grow.
yeah, yeah. For rental properties, especially because we don't have a lot of big crashes.
Mhm.
And during the crash of '08 to 2010, things did go down a little bit,
Yeah.
but during that whole time, people needed to rent,
Yeah.
and rents have steadily rose. And a lot of the properties that I've bought, during that time have increased in value. Some even doubled.
Mhm.
So they always say, "When's the best time to buy a house or plant a tree?"
Yeah.
Um, Today or 20 years ago was the best, and today's the best. So
Right.
I recommend people don't wait and time the market. You get a good deal, a solid deal that pencils out now.
Hmm.
5, 10 years from now, you probably won't regret it.
Yeah. I think, no, that's great. And I think something I'm sure you probably talked to people about, and I meant to mention before, you're talking about like tips and like things they should think about. I think really defining your buy box is huge.
Yes,
And once you do that, it makes it way easier to say no to properties that just fall outside of
our
it.
marginal, yeah.
If you're, if you're looking at the 1% rule and you're looking at certain areas but you just really want to make sure that buy box is well defined. So I think if you go outside of it, that's when you get into trouble.
You're exactly right. That's what I help people with a lot because they are out of state investors
Hmm.
and they see a lot of cheap properties or, the pictures look good, but they're just not in bad neighborhoods.
Hmm.
So I have sharpened my buy box down, basically 3 zip codes.
Hmm.
Um, so I'm pretty adamant, like the zip code I won't even look at. And yeah, that helps tremendously.
What are some other things that help define your buy box when you're talking to people about that?
Yeah, yeah. Usually I am that 1% rule
Hmm.
under a certain price range or above a certain price range too.
Hmm.
Because if it's lower than let's say like 60,000, I probably don't want to see it at this point, even though I,
Right.
I have done that before. And now I'm really strict about just the area, more for convenience sake and more because I know those areas. But I like to have all my properties within like a 2 mile radius of each other, just
Yeah.
as when I manage, just going all around town. Um, it's pretty simple though. There's not like 10 different things.
Yeah.
Basically, like the 1% rule, close to these zip codes,
Hmm.
and hopefully a C plus B class neighborhood.
Right. Do you keep that 5 to 10,000 in renovations in there too, as far as like cost to get it up and
Yes,
okay.
yeah, yeah. So that's another buy box thing. So I won't do anything that's over like 30 grand rehab for me
Okay.
personally. I'll just do 10 grand or less, just because
Hmm.
I feel like I can get it up running quick enough.
Hmm.
And that's just over time, just not wanting to deal with headaches as much and stress.
Yeah.
So I'd rather buy a little bit more, put a little up front, and have it rented out quick than wait 4 months and put 30,000 and just deal with all the headaches.
Hmm.
At this point,
I think it's really cool that you're doing this and you've got into and you're doing the real estate side and helping other people do what you do, as you've been doing this for 14 years now, right?
yes, in St.
In
Louis,
St.
yeah,
Louis,
yeah,
and you own many doors at this point,
yes,
right?
correct.
And you've self-managed the whole time too, right? Or most
Um,
of it?
yeah, at this point, I manage half of mine,
Mhm.
and I do have property managers that help me just for skill
Mhm.
and sake. But yes, I am very passionate about helping others right now
Yeah.
that don't know the market, and not everybody likes to deal with investors or property management,
Mhm.
and I just know how much stress and headaches it could be. So I'm hoping to make it easier for out of state investors
Yeah.
or in state investors as well.
Well, that's what I love about it. You've got the experience behind it. Not not every realtor, not every lender is investor friendly,
Exactly, and that's what
so
I want to, yeah, um, have my focus on.
right.
Not the homeowners and buying a dream home. That's amazing,
Mhm.
but I'm here to help people build wealth and income,
Yeah.
and
No
you're
doubt.
helping me with that.
Well,
All
likewise.
my all my clients, I refer to you first. So thank you for helping everybody throughout the years.
I really appreciate that. Yeah, thank you. No, you've been fantastic to work with.
Oh, great, thanks.
And did you want to talk about the property management side at all, or no? We leave that out.
Um, I do property management. I'm still growing that
Mhm.
side, and once again with the buy box
Yeah.
issue, there's only certain areas that I will
Right.
do. So there's some properties that I own and manage, but I don't want to manage for other people in
Yeah.
those areas. So yes, there's certain areas. So I hope that if you do work with me, then you know that you're getting a solid, good neighborhood
Mhm.
that works well.
And that's why I wanted to bring it up. Your experience on that side of it too is a big win for people who are working with you. So
Yeah, yeah. I think you should be adamant. It takes time though to like just know like no, I'm not doing this side. This
yeah.
one I'm doing. Really hard to do at first.
Mhm. I love it. Was there anything else you wanted to touch on?
No, I just want to say thank you and hope people got value out of this.
Yeah, I do too. It's always fun.
All right, we good to go.
Cool.